Welcome, everyone, as we delve into the profound wisdom of the iconic investor, Peter Lynch. Lynch's remarkable track record as a fund manager from 1977 to 1990, boasting an astounding average annual return of 29%, is a testament to his expertise. Through seminal works such as One Up on Wall Street and Beating the Street, Lynch has etched his legacy in the annals of investing history. His philosophy emphasizes understanding the businesses one invests in, a principle exemplified by his anecdote of students outperforming the market by investing in what they knew. Lynch's teachings transcend mere stock picking. They advocate for patience, long-term vision, and resilience against market noise. In essence, Lynch's insights continue to inspire and guide investors worldwide, empowering them to navigate the complexities of the financial markets with confidence and clarity. Let's delve into an intriguing anecdote from Peter Lynch's Beating the Street. A teacher, inspired by Lynch's investment philosophy, embarked on an experiment with her 13-year-old students. Dividing them into teams, she tasked them with a hypothetical stock market challenge. The twist? Before investing in any stock, they had to articulate the company's business and products to the class. Failure to do so meant exclusion from investment. The outcome astounded. The students surpassed the market, boasting a remarkable 70% return. This narrative vividly illustrates Lynch's fundamental principle of investing in what one comprehends. It underscores the potency of simplicity and understanding in the investment process, irrespective of age or experience. Lynch's teachings transcend the complexities of finance, advocating for a grounded approach anchored in clarity and knowledge. Peter Lynch's investment philosophy can be summed up succinctly: never invest in anything you can't simplify with a pencil. Essential to this approach is a deep understanding of a company's business model, revenue sources, and potential for growth. Lynch stresses the significance of thorough research and seeking input from others, as evidenced by the student's peer review process in his anecdote. If you can't articulate a company's fundamentals in terms a child could grasp within a minute, it's likely not a prudent investment. Lynch's emphasis on simplicity and clarity underscores the importance of diligence and comprehension in making investment decisions. Peter Lynch sees significant potential for individual investors in the retail sector. He emphasizes the importance of observing consumer behavior in malls, which can offer valuable insights into market trends. Lynch contends that successful retail companies capitalize on universal tastes, whether in fashion or food, presenting attractive investment opportunities. Drawing parallels to McDonald's historical success, Lynch suggests that astute investors can identify emerging trends and profit from them. By understanding shifting consumer preferences and staying ahead of the curve, investors can position themselves to benefit from the dynamic retail landscape. Lynch's approach underscores the value of thorough research and a keen eye for spotting opportunities in an ever-evolving market. Peter Lynch emphasizes the importance of maintaining focus on long-term fundamentals over short-term market fluctuations. He illustrates this by recalling events like the Gulf War scare, where market pessimism provided astute investors with buying opportunities. Lynch's advice is clear: tune out the noise and stick to your investment strategy. By avoiding reactionary decisions based on market sentiment and instead concentrating on the underlying strengths of companies, investors can better weather market volatility and achieve their financial goals. This approach aligns with Lynch's overarching philosophy of investing in what you understand and staying disciplined in the face of market uncertainty. Ultimately, by remaining steadfast in their convictions and resisting the urge to react impulsively to market fluctuations, investors can position themselves for long-term success in the ever-changing world of finance. Additionally, Lynch underscores the potential for investment opportunities amid adversity. For instance, he highlights the pandemic-induced setbacks experienced by airlines, emphasizing the importance of discerning between temporary hurdles and systemic issues. Investors should carefully evaluate whether a company's struggles are short-term and surmountable or indicative of deeper underlying problems. By exercising astute judgment, investors can capitalize on market downturns and position themselves for long-term growth. Lynch's insight serves as a reminder that amidst challenges lie opportunities for those willing to delve deeper and differentiate between transient fluctuations and fundamental shifts in the business landscape. When considering cyclical stocks such as automakers or commodity producers, Peter Lynch urges caution. Although low price-to-earnings ratios may appear enticing, they could indicate looming downturns. Timing becomes paramount. Investing at the cycle's nadir, when stocks are undervalued yet underpinned by robust fundamentals, can unlock significant returns. Lynch's approach underscores the importance of discerning between short-term fluctuations and enduring market trends. By exercising patience and astute timing, investors can capitalize on cyclical opportunities while mitigating risks associated with market volatility. Lynch's wisdom resonates with the adage that fortune favors the prepared mind. Hence, thorough research and a keen understanding of market cycles empower investors to navigate cyclical sectors successfully. In essence, Lynch's counsel advocates for strategic engagement, emphasizing the need for vigilance amidst market gyrations to seize optimal investment prospects within cyclical industries. Peter Lynch's wisdom transcends mere stock picking. He delves into the realm of investor psychology. He advocates for a reduction in market obsession, proposing more frequent market closures to discourage excessive trading. By adopting this approach, investors can sidestep the pitfalls of short-term thinking and focus on long-term value creation. Embracing the timeless principles of Warren Buffett, alongside Lynch's pragmatic insights, empowers investors to navigate market volatility with confidence and conviction. This holistic approach emphasizes the importance of disciplined, patient investing over reactionary decision-making. Ultimately, by prioritizing fundamental analysis, maintaining a long-term perspective, and minimizing the noise of daily market fluctuations, investors can cultivate sustainable wealth and achieve their financial goals. In essence, Peter Lynch's investment philosophy underscores simplicity and pragmatism. His approach hinges on grasping the businesses we invest in, maintaining unwavering focus on long-term fundamentals, and disregarding transient market fluctuations. Lynch's mantra, "Buy cheap and sell dear," encapsulates a timeless principle applicable to investors of all stripes. By adhering to these principles, investors can replicate Lynch's remarkable success. His emphasis on thorough understanding, coupled with a steadfast commitment to sound investing principles, serves as a guiding light in navigating the complexities of the market. In a world often inundated with noise and speculation, Lynch's pragmatic approach offers a beacon of clarity, reminding us to stay grounded in fundamentals and approach investing with a clear-eyed perspective.